In this process, there is a roughly 50,000 crore worth of stimulus just because of this. In addition to that, because of the cess, additional 1 lakh crore.
Where do you think the valuations are currently? India still remains one of the most expensive markets compared to the emerging markets. So how do you look at valuations at a domestic level and compared to the EM?
Valuations compared to EM has definitely corrected a lot in last 1 year because EM has outperformed big time. On a relative basis, yes, the valuations are reasonable. However, one should look at it from a point of view of on what kind of returns we are sitting on.
Hello investors, welcome to Moneynomics by Axis Mutual Fund. I'm Shalini Gautam and I have with me Head of Equity Shreyash Devalkar. Today, me and Shreyash will discuss the key developments in the markets, which is the impact of GST rationalization, the way the earnings cycle has panned out, and what does it mean for investors. So Shreyash, let's begin with the very first aspect of the markets, which is GST rationalization. How do you see this playing out in terms of the consumption cycle?
Sure. So first of all, it's a really great move when it comes to simplification. That has been the key objective of it. Apart from that, this rationalization, the way it has happened, there is a removal of 2 rates and only 2 rates remain.
Yeah.
And in which a lot of goods, which has actually the tax is reduced. In this process, there is a roughly 50,000 crore worth of stimulus just because of this. In addition to that, because of the cess, additional 1 lakh crore. So it's almost 1.5 lakh crore kind of stimulus which is there in the market, and the key beneficiaries is right from the FMCG, consumer durable, auto, in certain parts. So this entire gamut is definitely up for benefit. Here the key is that obviously this benefit will be passed on to the consumers. How much is the elasticity of demand that we need to see? So every item may not see the elasticity of demand. Just to take a case in point, say cement. Cement as a overall component of overall construction of house or any infrastructure project, this cost is not the real determinant. Yes. So to expect that there is going to be any demand elasticity because of fall in the GST, that is not the right assumptions to have. So if you go by this, then yes, there are certain items, especially in the consumer discretionary, we see that there is going to be elasticity. In consumer staples also, especially the food items, there will be elasticity. While in the staples, there are categories which are more penetrated, in which demand elasticity may not be seen.
Okay. Coming to the earnings season, we are almost in the last leg. How do you view this earnings season, especially also given the fact that going forward there could be an impact of the tariffs hike built into the companies? So how do you see this season panning out?
So if we just combine these two, as far as the tariff is concerned, especially the tariff impact is going to be seen in the quarters coming, which are going to come in next and after that. As long as obviously this tariff stays, that we also don't know that how long it stays. But broadly, the impact is going to be there. Most of the impact is for unlisted space as of now. Overall country level impact is, as per various economists, is expected to be around 0.3% on GDP and as well as on the current account deficit. So it will have some repercussion on current account deficit as well. But again, provided this tariff continues. Mm-hmm. So the impact on the listed space is limited. While on the unlisted space being there, it may have an indirect impact on certain segments. It can be textile, it can be auto ancillaries, but not all of them, because there are certain exempted items also. Mm-hmm. We have to see whether that exemption continues or not. But broader impact on the economy is what I just talked about, is almost 0.3% is what is being calculated as of now.
Okay. Where do you think the valuations are currently? India still remains one of the most expensive markets compared to the emerging markets. So how do you look at valuations at a domestic level and compared to the EM?
Valuations compared to EM has definitely corrected a lot in last 1 year because EM has outperformed big time. The outperformance of EM is driven by multiple things. There has been a trend towards by AI beneficiaries. Yeah. Yes. There has been trend towards investment in biopharma. There was a drive towards anti-involution drive in China, because of which the investment has gone in there. So we were actually at a very high premium to the emerging market over last 1 year because of the underperformance of Indian market. Now our premium to the emerging market is in line with the long-term averages. And with that, on a relative basis, yes, the valuations are reasonable. However, one should look at it from a point of view of on what kind of returns we are sitting on. If you look at 3 year CAGR of mid and small cap are somewhere around 23% odd. In large cap, it is somewhere around 17-18%. So to me, this 23-24% CAGR return is very high return, which we are sitting on. Once it gets normalized towards, say, nominal GDP growth plus few percentage points, because as that's what we believe that long-term returns from the market expectation should be nominal GDP growth plus returns, and that sort of resetting is actually, in my judgment, broadly has happened in the large cap. In mid cap, with time correction and with some time, there we will be there in a year or so. So in my judgment, it is going to be this time correction which is market has undergone, because of which valuations are coming down. You can call them reasonable, but you cannot call them attractive.
Okay. Now, against this entire backdrop we have spoken about, where are you finding opportunities in the market and how are you positioned?
So our positioning as usual has been around quality and growth oriented stocks. Mostly in the large cap oriented investments are mostly in the B2C side. It is in consumer discretionary. It is in the themes like quick commerce. It is in the retail space, telecom, hotels and tourism. So these are the key spaces where most B2C oriented investments are. While in case of B2B oriented investments, which are more in our mid and small cap oriented schemes, these are in capital goods, especially towards power sector, capex oriented companies. These are also in electronic manufacturing services, and around that theme, there are certain beneficiaries in auto ancillary. Healthcare hospitals are mostly in this space, so they are also doing well. We have reduced certain exposure to capital market oriented theme, but still the exposure remains there.
Okay.
So these are the key spaces where we are invested now.
My last question to you, what would your advice to investors be in this current market environment?
Broadly, most of the both positives and negative news at this current point in time seem to be there in price. Especially in the large caps, the valuations are reasonable, while in case of mid cap, still in really high growth stories, the valuations are not in sync. So in my judgment, it's better to be in a diversified funds. So from our house, we always recommend that multi-cap, flexi-cap, large and mid cap and ELSS. These are the categories which are generally diversified fund categories. So in these categories, one should stay invested most of the time.
Thank you so much, Shreyash, for your valuable insights. And thank you to all our investors. Stay tuned into Moneynomics.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.